Hey folks, welcome back to the channel, and today we're going to talk all about LEAPS, which are long-term options. LEAPS stands for Long-Term Equity Anticipation Securities, and it's basically the same thing as any other option, except LEAPS have an expiration date of at least 1 year away, and up to usually 3 years. Now, typically I trade monthly or weekly options, but LEAPS is at the other end of that time spectrum where you don't have to worry about it expiring until at least a year later. Now, why would investors use LEAPS as an option strategy? Well, typically you would use this if you have really high conviction on what an underlying is about to do. Like maybe you think a stock is really underpriced because its valuations are super cheap and you think it's going to go up, especially long term, or a stock has just broken out technically and you think it's going to have a lot of upside. And then the 1 year plus time duration comes in play when you want a longer time duration for your options, because it's often easier to predict the underlying price further out into the future than in the short term. So I'll give you an example. From this Forbes article, the average bear market lasts 289 days. That's just under 10 months. And the S&P 500 has already been going down for almost a year now. And we don't know if by next week or next month the market's going to fall further from here, or if we've already reached the bottom back in October and now we're at the start of a bull market. So it's hard to say short term. However, whenever we get a pullback, it is likely that the stock market will return positively over the next 3 months. Because in 2022, this year, the stock market fell just over 25%. Over the next 3 months, historically speaking, the stock market returned 7.2%. However, if we go a bit further out and look at the 6 months, the average return was 10.6%. And that's because bear markets don't last forever, the average being under a year. So if you're willing to wait a whole year after the S&P dropped 25 to 30%, now you're looking at almost 20% return on average. In fact, it doesn't matter if the stock market is down 5 to 10%, 20 to 25%, 40 to 45%, or even 50%. Every single time, on average, you get higher returns as you wait longer for the stock market to recover. You're getting more certainty that you're going to have a positive return the longer out you wait. I posted this chart on my blog a while ago. So this is a list of all the times when the stock market was down 25% or more since 1950. And the last row item here is for this year, 2022, which we don't have the data yet. But for all the other years that we have data, you can see that the 1 year return has been pretty good, except in the great financial crisis. That lasted a bit longer than what most people thought. But if you look at the 3-year return, you get a positive number. And it's the same thing. The further out you go, the higher the average expected return, especially 10 years. But for LEAPS, it's typically 1 to 3 years. So you're looking at these two columns. So that might be a reason that you want to have a longer time to expiration, is because it's easier to predict where stocks are going to be after a year from now than where they're going to be like in a couple of weeks from now. So there's a lot of reasons why you might want to use LEAPS. You can use it as a way to leverage to buy stocks that you think are going to go up. You can also use LEAPS to hedge against a market downturn, which would have been really nice at the beginning of this year to do. But in this video, I'm going to show 2 examples of how I would use LEAPS that should give you a pretty good chance of making money without too much risk. So let's take a look at Tesla just as an example. If I look at the options chain for Tesla going out to January 19th of 2024, that is at least 1 year away. That's 434 days. So if I buy or sell any options in here, that would be considered a LEAPS. If I take an at the money option here, let's say the 193 here, and look at that pricing, that's $51 for this call if I want to sell it. If you watched any of my other options videos, you would know that I do not normally trade options that are this expensive, right? So why are the prices so high for this? Whereas if I go to, let's say November 18th, which is expiring this upcoming week, well, now the option premiums are more down to earth. So what's going on here? Well, let's talk a little bit about option pricing and how the premiums are determined. Like, why is the November 18th expiration premiums worth about $6, whereas LEAPS for the same strike price is worth like $50? Because if you understand how options are priced, then you can make better decisions when you're trading them. The price of an option is just the sum of 2 components, the intrinsic value and the extrinsic value. When you add those 2 together, you have the final option price. Let's talk about intrinsic value first. It's pretty straightforward. Let's say you have an Amazon call option with a strike price of $100. The intrinsic value of this option is simply how much the option is in the money. So for example, the current market price of Amazon, let's say it's $110. It's not, but in this case, let's say it's $10 higher than your call option. So what is the intrinsic value? Well, to figure that out, you just basically ask yourself, if you exercise your option right now, how much money would you make? The call option gives you the right to buy Amazon shares at $100, but the current market price of Amazon is $110, so you make a $10 profit. So in this case, the intrinsic value would be 10 because that's how much value is intrinsically in this option. Now, let's say instead of 110, Amazon is currently trading at $95 today. Okay, what is the intrinsic value in this case? Well, if we exercise this option right now, we can buy it for $100, but oh wait, the market is only selling it for 95. So why would we pay somebody $100 for the stock when we can just buy it at 95? So the intrinsic value is actually zero because you can't have negative intrinsic value. So if the option is out of the money, you have zero. If it's in the money, then the intrinsic value is just how much is it in the money. So just as an example, we can take a look at the Tesla options here again. At the 190 strike, you can see the call option is about 2.6. But if I go $5 lower for the strike at 185, you can see the call options are around $7. And that's because the intrinsic value for this 185 is $5 more than the 190, because if you exercise the 190, then you make about 155, which is the difference between the stock price and the option strike. But if you exercise the 185, then you make $5 more essentially. So this option is expiring today, 0 days. So the 190 strike has an intrinsic value of about $1.7, right? But the option price is around 2.5, 2.6. So there's that extra dollar of value there. And that is where the extrinsic value comes in. This is the other part of the option price that when you add together with the intrinsic value gives you the total price of the option. So what is the extrinsic value? It's basically a product of time decay and volatility. So going back to this Amazon example, the extrinsic value is what people are willing to pay for the option even though it's not in the money. So if this Amazon call option was to expire today and the current market price is $95, then the extrinsic value is going to be really low, maybe even zero, because it's not that likely for Amazon to jump up from 95 to over $100. But let's say this Amazon option is expiring sometime in 2024. Well, now we have a lot of time from now until then. The extrinsic value is going to be a lot higher because Amazon has a lot more time to get to over $100, which is when this call option will actually be worth something intrinsically. So maybe by then Amazon is trading at $150, which is not unreasonable to expect. Well, now if you have the call option, you can exercise it and you can basically make $50 per share or $5,000 for the whole contract. And because there is that likelihood for Amazon to go up that high, people are willing to give value to this option right now. They're willing to pay for the privilege to exercise this before the option expires. So this is how the extrinsic value works relative to how long the expiration date is. Let's say we buy an option contract today and it expires in 12 months. At the very beginning, this option has really high extrinsic value, but 6 months later, it's going to lose about 1/3 of its extrinsic value because there is less time for the stock to move up if it's a call option to expire in the money. And assuming everything stays the same, then about 1 month out, that extrinsic value is basically going to collapse because simply time is running out. So when I trade 0 days to expiration options or weekly options, I'm playing right here near the very end of that time spectrum, whereas for LEAPS, it's kind of the other end of that, where instead of relying on time decay and trying to capture that value as it falls, I'm relying on fundamentals and longer-term price movement of the underlying. So now that we understand how LEAPS is all about maximizing the extrinsic value, we can take this into consideration if we're buying or selling LEAPS. So if an option's intrinsic value is $5, meaning it's $5 in the money, and its extrinsic value is $2, then the total option price is going to be $7. And if you sell that option, you will collect $700 in premiums. And if you buy that option, you will pay somebody else $700. So now that we've looked at how options are priced, let's do a couple examples of LEAPS to show you how I would go about taking advantage of that long-term time span. So, for example, I'm really bullish on a stock, and I realize that short term there could still be a lot of downside movement, as you can see with this channel. However, I do believe that there is a nice support at around the $100 level here. It's too much of a guessing game, trying to figure out where the stock will go over the next month or so. But I basically want to make a leveraged bet that at least 1 year from now, the stock will be a lot higher. Let's look at earnings and fundamentals first. For this company in particular, CrowdStrike, which is a security company, the top line is growing fairly fast. They're not quite profitable yet because their earnings are still negative. However, the company has become free cash flow positive over the last few years. The website Simply Wall Street uses a discounted cash flow model and gives the stock a fair value of $227, which means that it is 40% undervalued today. If we look at tip ranks, we can see that analysts are in consensus. So if you buy the stock today at 143 and it goes up to the expected 12-month target of 236, then you would make 65% on your money. But of course, using options, you can leverage your money and make a lot more than that. And one strategy of using options to give you higher potential returns is to use LEAPS. So I'm going to use LEAPS to demonstrate how you can capture that potential upside with options. So looking at the chart again, I'm going to point out the previous resistance where the stock had trouble going over, which looks like it's right around here in the $200 range, because in the summer the stock dropped down and it tried to climb back up, but it got stuck here. And it also got stuck here in the past and over here as well. So I think this is a pretty strong resistance here. If the stock goes higher, then it can easily go to 220 or 240. As you can see, the next resistance after that isn't until we get into the 240s range. So I'm looking at $200 as my strike price for a bull leaps call, and I may actually turn it into a spread in order to save some money. Now, I want to choose a strike price that is not too high, because if I choose 280, then there's not a very high chance the stock will go up that high. Let's take a look at the option chain for CrowdStrike, and I'm looking at the January 2024 expiration, which is over 400 days away. And you can see at a 280 strike price, there's only a 19% chance that the stock will go up that high. But I also don't want to choose a strike price that is too low. For example, the current stock is at 144. If I choose like a 150 strike, for example, the problem with that is I would have to pay a very large sum of money in order to buy that option, about $3,500. Yes, there is a 62% chance that it will expire in the money, which is better than 50-50, but it's not that much better. If the bear market goes on for another year and the stock ends up being like 149 by January of 2024, then this option will expire worthless and I would have just paid a lot of money for nothing. Another thing that I want to make sure of is that analysts have a high price target for this stock. So for example, the lowest price that analysts on tip ranks are giving this stock is a $200 price. Meaning if 12 months from now, the most bearish analyst out of like 40 different analysts happens to be correct and the stock is at $200, then at least I would have a chance to maybe break even with this option. So looking at the option chain here again, I'm going to go to about $200 and I'm going to buy the call option for January 19th, 2024. Now, I could just pay $1,910 and then just cross my fingers and hopefully by the beginning of 2024, the analysts turn out to be correct and CrowdStrike goes all the way up to $235, because then I can buy the stock for $200 even though it's worth $235, which means I make a profit of $35 per share times 100, $3,500. And of course, I have to subtract the initial premium that I paid somebody in order to have the privilege to have this option, which is, let's say, $19.10. So that's my total profit of $15.90, assuming CrowdStrike goes up to $235. Now, some people like to buy at the money options for LEAPS. So if I go to like a 145 here, this is basically at the money. I probably wouldn't do this again, just because you're risking a lot of money here, and there's still a 1/3 chance that you could lose everything. So although there is probably a time and place for at the money and even in the money call options for LEAPS, it's not something personally I would do because the risk to reward for me is just not really there. Now, instead of just buying a call option, what I'm actually going to do today is reduce my risk a bit and buy a call spread. So what that means is I will buy the call option at $200 strike, but I do not want to pay like $1,900 because there's a chance that the stock price will not be above $200 and I can lose all my money. So what I will also do at the same time is sell a call option that has a higher strike price, let's say the 220. Okay, so now instead of paying $19.50, I'm going to pay the difference between the two, which looks like it's going to be about $400 or $500. You can see that the margin impact is zero, and that's because there is no risk to getting assigned stocks or anything with this. So the most money I can lose is this $460, which as soon as this transaction fills, then I've already paid. So the nice thing about buying LEAPS is just like buying any other options, the maximum amount of money you can lose is already well defined. It's going to be what you pay in terms of the net premiums. Okay, so I'm going to try to pay a little bit less for this. Right now the mid price is $455, so I'm going to go with maybe $445 for now, and I'll transmit this. So because I'm selling the 220 strike, it means the buyer of this option will have the right to buy it from me at $220. So if the stock goes up to $280, let's say, then I can't actually make the difference between 200 and 280, which is $80. I'm going to sell it to somebody else for 220, making the difference of $20 or $2,000. So by buying a spread instead of just buying a single option, I do cap my upside, but at the same time, I'm not paying the full like $1,900.
Order filled.
Okay, so that filled at 450. Now, if the analysts are correct and it goes to 220, 230, then of course I'm going to make that $20 difference between 200 and 220. Minus the $450 that I paid in premium. So that's going to be my total profit. And I think this is a pretty good potential reward considering the risk I'm taking, because I'm basically putting up $450. So that's pretty much like tripling my money. Now, the chances of me tripling my money is not that high. If the stock price goes up to 220, which is the most I can make from it, that's only a 35% chance. But I think if the company continues to grow, then by this time, January 2024, which is where this blue line is, I do expect the stock to do something like that. So that's one example of LEAPS taking advantage of that longer term outlook, because short term, the technicals are still pointing downwards. I don't think the stock is going to recover anytime soon. At least it's not going to get above $200 anytime soon. But by 2024, there is a much higher chance of it doing so, especially when this company continues to beat earnings every quarter. And of course, buying call options are pretty exciting because you do have that potential to make many times what you've put up. And the other thing is, I don't have to wait until 2024 to get out of my position. I could make a quick profit if the stock goes up really high like this and it passes the $200 mark before it gets to 2024. I can just sell my call spread and basically make a profit that way. So even if the stock price were to fall back down, I would have already gotten out of my position. Now, another strategy that you can use with LEAPS is selling put options, right? So LEAPS are just like any other options, except they're just longer. So the way I like to sell put LEAPS is to choose index funds. And that's because with individual stocks, you never know. Because with the previous example, I think it's better to choose individual stocks that you think will outperform the market, because that's how you can get those outsized returns. And the most you can lose is just whatever you put up, whatever you paid for the premium. But with put options, the downside is a lot more. So it's technically more risky, and therefore I would use something like index funds. So although selling options is not as exciting as buying options, personally, I like doing this more, especially with LEAPS, because you get a very high certainty of making a profit with your trade. So in terms of which index I'm going to be looking at, for large caps, the forward PE ratio is still pretty elevated at 17. You can see we're right here. So because I'm looking for value, I'm not going to be using a large cap index. Mid cap is pretty good. We're below average. But what I want to look at, and I've talked about this in previous video, is to sell a put option on small caps. And right now, small caps are trading at a very big discount with a 12.4 forward PE ratio. Now, one index fund that tracks small cap stocks is the Russell 2000. So the ETF I'm going to be using, because it has a lot of liquidity, is IWM, the iShares Russell 2000 ETF. It is a very diversified basket of about 2,000 individual stocks. And you can see the sectors are very well spread out, so you don't get a lot of high concentration in one particular sector. So looking at the PE ratio chart, I want to pick basically the lowest this PE ratio has been over the last, looks like 2 decades or so. And if I draw a line down here, it looks like it's about 10, and that was in 2008, where the financial sector almost collapsed. That was when sentiment was the most bearish out of all of these years. So the current PE ratio is 12.4, and in order to be safe, I want to be able to buy the index at a PE of 10. Because I'm fairly certain that even if the stock market does drop to a PE of 10, it will not last that long before bouncing back up. Now, IWM is currently trading at 187. So to figure out what is the lowest price that I'm willing to pay for my put option, we can basically just cross multiply to get that answer. So 10 times 187 and then divide that by 12.4. So that gives me, I'm going to round it to 150. And that's going to be my put strike. Now, this is looking at things from a fundamental view. I also like to take a look at the technicals to see how that lines up. So looking at IWM, what I like to do is use weeks or month. I've also turned on a log chart. If I draw a straight line that hits all of the points, I did this with my Google challenge last week, if you saw that video, where I basically just line up the bottom weekly closes of, that was 2008, and this is in 2020. So it's going to look something like this. And then for the expiration date, let's take a look at the option chain for IWM. For this to be a LEAPS, I am looking for an expiration date that is 1 year or longer. So that would be December 15th would be the closest expiration. At a $150 strike, that would give me a premium of about $7. So let's look at that on the chart. December 15th expiration. I'm going to put a line in here at the middle of December. So it looks like it's going to be about 146. I mean, that's pretty close to 150. So it's nice to have that confluence where the technicals and the fundamentals kind of line up and tells you that there is a very good chance that even if it does fall, it will not go past around 150 because that's kind of like a very hard support. So I'm going to sell this put option, 688, probably make about 695, something like that. I'm going to try to make $7 with this, and the margin impact will be 3,400. So I need to have 3,400 in order to make this $700. That would be my premium. Now, in this case, I'm not going to use a spread. So I'm just going to sell this one option. I'm not going to buy like a 140 or a 135 for protection because honestly, if IWM falls below 150, then I'm willing to pay 150 for that, even if it falls to like 130 or 110. So I'm basically going to make $700 in premiums, and I will need $3,400 to back up this transaction. Now, what do I need for this to break even? Basically, my $150 minus the 700 that I'm getting. So as long as the ETF stays above 143, then this will have been a profitable trade for me. Okay, I'm going to drop this down to maybe 694.
Order filled.
Okay, 692 is where it got filled. So from now until December of 2023, as long as the stock stays above 150, then I'm not worried about the owner of this option exercising. And after 399 days, if the option expires out of the money, then I would have just made $700. Of course, the further out of the money you go, the less likely your options will expire in the money. So if I use the 100 strike price and I sell that put option as a LEAPS, you can see I can make about $150, which is not much, but also there's a very small chance that IWM will fall to $100 by next year. So to recap, I would use LEAPS in a couple of different ways. If I'm really bullish on a stock, then I would buy bull calls on it, and it would look something like this, where my maximum loss will be known, and this would be like a negative number here, and that's going to be the premium I pay. But the maximum potential is unlimited because if the stock price, as long as it goes above this break-even point, then really the sky's the limit. If the stock goes to like $300, then the profit would be astronomical. Now, what I did today was alter this a bit and basically made it into a spread. So what that means is instead of the unlimited potential gain, it's kind of capped at a certain level. With the CrowdStrike example, I bought the 200 call and then I sold the 220. So the maximum I can make is $20 there. And another way I would use it is to sell puts. So in the example today with the Russell 2000 ETF, I basically make money as long as the fund stays above 143. If it's between 143 and 150, then I'll have to give up some of the profit from the $700. So LEAPS are really just puts and calls. They work exactly the same way, they're just longer duration. And because markets are more predictable long term, a lot of option traders like to use LEAPS. Now, I don't use LEAPS all that often because I find it ties up capital, and I'd rather use that capital for more like short term selling options, taking advantage of theta decay. So anyway, thanks a lot for watching. Hopefully you got something out of that. And if you find the right circumstances, maybe you can incorporate LEAPS into your own option strategy. In any case, good luck with your investments, and I'll talk to you in the next one.